Losses are not personal. They are purely statistical data points. The market does not know you exist. It does not track your entry, and it certainly does not care about your financial goals. It processes orders based on liquidity and nothing more. You did not lose that trade because the market hates you or because a broker is watching your account. You lost because you misunderstood the fundamental structure of the environment. The market is not a casino, nor is it a battleground for your ego. It is a highly engineered auction mechanism designed for one purpose. Its function is singular and cold, to facilitate the exchange of risk between participants. It discovers price through the relentless search for liquidity and volume. An auction has no morality, and it has no fairness doctrine. It has no obligation to respect your technical analysis lines or your indicators. It moves toward imbalance and away from equilibrium solely to facilitate trade and find willing participants. The moment you place a trade based on hope or fear, you are no longer a participant. You become the product. You become the liquidity that the machine requires to function. The machine feeds on the emotional reactions of the uninformed. Most traders fail because they interpret this mechanical process through an emotional lens. They see manipulation where there is simply inventory transfer between strong and weak hands. They see intent to hurt them where there is only balance sheet necessity. They assume large institutions are hunting them personally to steal their money. This assumption gives them a strange comfort because it allows them to believe losses are external. But this is a lie that keeps you poor. The market is efficient at one thing above all else. It transfers capital from the impatient to the patient, and from the emotional to the systematic. It is a redistribution engine designed to punish impulsiveness. Think about your last major loss in the market. Did you enter because the setup was mathematically perfect, or because you feared missing out? Did you exit because the structure broke, or because the pain became too intense for your nervous system? The market is designed to exploit these specific biological triggers in your brain. It utilizes fear and greed as fuel to generate movement. When you panic sell at the bottom, you are not just losing money, you are providing a service. Your pain is their entry requirement. Your capitulation is their accumulation. When you sell in fear, you provide the liquidity that an institution needs to fill a massive buy order without slipping the price. You are the exit liquidity. Let's strip away the conspiracy theories and look at the actual mechanics of the order book. Large participants like hedge funds and banks move price because they must. They are not moving price to annoy you. They have size constraints. If a desk needs to accumulate $1 billion worth of a position, they cannot simply click buy. There are not enough sellers at the current price to fill that order. If they did, they would slip the price upward instantly. Instead, they need a massive counterparty to take the other side. They need a mass of sellers to absorb their buy orders. Where do they find these sellers in a quiet market? They find them where the retail crowd places their stops. When price dips below a visible, obvious structural low, it is not attacking you. It is asking a question. Is there supply here? It is probing for the liquidity pools that exist beneath obvious support levels. When thousands of retail traders place their stop losses below the exact same obvious support level, they create a pool of concentrated liquidity. To you, that stop loss is safety. To an algorithm seeking size, that cluster is gasoline. It is the only place where they can fill large orders efficiently. So the price drives down, sweeps the lows, and triggers your stops. Your stop loss becomes a market sell order, which feeds the institutional buy order. The institution absorbs that selling pressure completely. Once the supply is exhausted and their bags are full, price reverses and rallies hard. You sit there feeling cheated, claiming the market is rigged against the little guy. It isn't rigged. It is ruthless efficiency in matching orders. You provided the exit liquidity they needed to enter their position. This is not personal malice. It is the mechanics of a global auction. Understanding the trap is only half the battle. The real enemy is not the algorithm. It is your own biology. Your brain is wired for survival on the savannah, not for probability in the financial markets. We are evolved to seek certainty and avoid pain at all costs. But the market is an environment of pure uncertainty. When you win, your brain releases dopamine, reinforcing the behavior even if the trade was reckless. When you lose, your brain triggers a threat response, bypassing logic. This forces you into fight or flight. In trading, fight looks like revenge trading and increasing leverage. Flight looks like cutting winners early to relieve anxiety. To defeat the machine, you must stop thinking like a human. You must start thinking like a casino. The casino does not care if a player wins a jackpot on slot machine number 4. The casino does not get angry. The casino does not try to win the money back instantly from that player. The casino knows that over a series of 1 million spins, the mathematical edge is in their favor. They simply keep the doors open. They let the probabilities play out over time. You must become the house. Here's the only truth that matters. Markets reward statistical advantage, not emotional conviction. Your feelings are irrelevant to the data. Positive expectancy is not a motivational quote, it is arithmetic. Expectancy equals your win rate multiplied by your average win, minus your loss rate multiplied by your average loss. That is the only formula that counts. There is no magic indicator. If your system wins only 40% of the time, you can still be wealthy. Provided your winners are 3 times larger than your losers, the math guarantees profit over time. However, most traders sabotage this equation in 2 predictable ways. They cut winners short because profit feels fragile and they fear it will vanish. And they extend losers because hope feels necessary to avoid the realization of loss. Both behaviors invert the math and ensure bankruptcy. You are actively working against your own survival. An operator does the opposite. He is impatient with losses and patient with winners. He realizes that a loss is just a business expense. He accepts that variance is the cost of doing business. If you participate long enough, losing streaks will occur. 5 losses in a row are not evidence of failure. They are statistical inevitabilities over large sample sets. Variance is not the enemy, it is the cost of admission. An operator measures performance across 100 trades, not one. 1 trade is noise. 10 trades are noise. Patterns only emerge through repetition and consistency. This requires psychological neutrality. If your emotional state changes based on the last trade, you are too leveraged mentally. This is why risk must be defined before execution. You must know your exit before you know your entry. Capital preservation is not defensive, it is strategic. If you lose 50% of your capital, mathematical recovery requires a 100% return. The deeper the drawdown, the steeper the recovery curve becomes. Therefore, the primary objective is survival. Survival enables repetition. Repetition enables statistical edge. Edge enables growth. Without survival, expectancy is irrelevant because you are out of the game. You must stay solvent to play. Now consider volatility events and news. During high-impact news, spreads widen and liquidity thins. Retail participants attempt prediction and gamble on direction. Professionals do not gamble. They observe the reaction to the news. The number itself is secondary. The market's response to the number is primary. Does aggressive selling create displacement, or does it fail to sustain new lows? If heavy selling cannot move price lower, absorption is occurring. Passive buyers are present and absorbing the selling. This is information. Order flow reveals intent more accurately than headlines. An operator waits for confirmation of imbalance before risking capital. He defines invalidation and calculates risk in R multiples. He accepts the loss before entry. Acceptance precedes execution. If the thesis fails, the loss is processed. No adjustment, no negotiation. The trade was one sample. If the thesis succeeds, profits are managed according to predefined structure, not emotion. This repetition builds consistency. Consistency builds data. Data builds confidence. Confidence reduces impulse. At this stage, trading is no longer dramatic. It becomes procedural. It becomes boring. The market is an auction, and auctions are indifferent. They do not reward effort. They do not punish arrogance. They simply match orders. If you require excitement, markets will supply volatility and take your money. If you require discipline, markets will test patience and give you wealth. Only one of those requirements compounds capital. The objective is not to be correct. The objective is to be solvent. Solvency allows participation tomorrow. Participation tomorrow allows the statistical model to function. Without structure, trading becomes entertainment. With structure, it becomes allocation. You must build a framework where your edge is mathematical. The Stoic desk field manual is not a promise of wealth. It is a structured doctrine for managing uncertainty. It is a shield against your own psychology. We are building operators, not gamblers. An operator respects the downside. An operator knows that the market is a river, and you cannot control the river. You can only control your boat. Silence the noise of the news. Respect the variance of the math. Protect the capital in your account. Execute the process without hesitation. This is the only way to survive the machine. End of transmission. Initialize the protocol. Signal your status in the logs. Confirm operator to initialize. The market is waiting, and it does not care if you are ready. Execute.